which involves when we decide to purchase a non-current asset, which is your property or plant or equipment. So we need to budget for that, because if we didn't do our proper budget, then automatically we might lose, we might not get the returns at the end of the day. So you kept at budgeting. In this chapter, you look at the outcomes of this chapter. You'll be able to describe what is kept at budgeting process, explain the purpose of investment appraisal, identify a project relevant cash flows, analyze an investment project cost, benefits, and risk. And then we'll be able to calculate a projected payback period, net present value, internal rate of return, and lastly, evaluate investment projects. So in other words, this is what we expected at the end of this session. In your chapter outline, it would be an 8.1 introduction, capital budgeting process, your categories of capital budgeting projects. Why do organizations use appraisal, investment appraisal, relevant and irrelevant cash flows in investment appraisal, as well as the methods? Those are capital budgeting techniques. Those are methods that we use when we work out which project we have to consider, or which one we need to decline. All that, it will be covered in this chapter. In your introduction, that is your stages, which is so important, because I know you need to look at this. First one, before you decide for any project, you do a screening. So in other words, you are selecting from others. You do a screening. Must screen the various types of capital investment projects that are necessary in order to achieve its objectives. So it should be in line with the company's objectives. So that's why you're screening. You have to do your screening, but you can't say if you screen this project, then you are happy, it's in line with the objectives of a company, then you consider as a project that you need to invest or you need to purchase, like plant. But there are a number of stages that you need to consider before you say this is the final project that we need to implement. After screening project stage, you move to search stage. So in other words, you do research. This plant, it's a new plant, or we need to do some repairs, and then we have to use that plant. So that is a search stage. When it was purchased, who was the supplier? So those items you need to consider before you take a decision. Organization need to obtain more information regarding the alternative investment projects that are available. This will enable them to make more informed decisions when investing in specific projects. As I mentioned in the last class, that this work, it's prepared or is done by management accountants, those who did management accountants, those who follow the career, CIMA career, then they are able to work out these stages. Then the next stage, which is stage number 3, information acquisition stage. When you acquire any asset, there are additional costs that you need to consider as a business person. You need to consider additional cost, but you need this information of inquiry. An organization needs to consider the predict revenues, cost, and the impact of alternatives. So in other words, as I mentioned, information acquisition cost. When you acquire any plant, there are costs. It's not only the purchase price that you have to pay, but there are costs that you need to consider. But at the end of the day, the same plant should generate the revenue at the end of the day. Then the next stage is authorization stage. This stage is most suitable project that meets the organization. So in other words, at this stage, now you know this project, it's in line with the objectives of the company, meets the objectives of the company, and benefits of which exceed the cost would be selected for investment. So in other words, if the benefits are exceeding cost, So in other words, this is the project that we need to select. Then the next one, number 5, is the financing stage. So to finance the project, we'll use our own money or we use borrowed money. So the finance department will take care of that. The organization now needs to obtain funds for the project that it has chosen to invest in. So in other words, we have to use our internal or external sources to fund the project. If it's an external source, it should go with the loan we need to pay back plus interest. So that is if we consider going outside. So it is the responsibility of the Treasury Department to arrange funding for the organization. So the last stage is the implementation stage. The chosen project will be implemented, constant monitoring of how the performance of the project is progressing. It's vital at this stage. So in other words, once we implement, we took the decision that this is the project that we are going to use or to purchase as a company so that it will be able to generate our own revenue. So that stage, it's so important, but we need to keep on monitoring the progress of this project. Also, projects are classified in certain categories, whether the company is expanding. So in other words, we are opening branches to other areas or other townships, or we go to other provinces, or even in other countries, African countries or other countries. So if it's an expansion project, see if you know, traveling or taking this project, it's an expansion. We moved to Namibia, so there are costs that are involved in that process. So we need to consider that, whether the project that we have to implement or we have to consider, it should be classified in one of the following: whether it's an expansion, the business is engaging in projects in order to increase the size of their businesses, or it's a replacement project. We are not happy with the certain item because it produced less at a certain time, then we need to consider replacing that project. So their cost of replacing the project, or is a regulatory project. So in other words, we are running a business in a certain environment. Maybe there are complaints, from the community. We need to consider that as well, because if it's not considered, we'll pay more, will be charged more as a company. So sometimes instances, certain projects have to be undertaken by organizations because they are required by law to do so. This may be necessary to improve safety at work or to preserve the environment. So that one also should be taken regulatory projects. If it's a new project, we never engage in this project, it's a new project, but we should be able to classify those projects into 4 categories. Why do organizations use investment appraisal? So 2 things that we consider here, which is why the organization use investment appraisal. There are 2 items that we need to consider. Number 1, it has to make a decision regarding the asset to be required. So in other words, an organization has to deal with 2 decisions in order to address its capital budgeting alternatives. It has to make a decision regarding the assets to be acquired. That is number 1. Number 2, it must decide how much the organization is willing to spend to acquire those assets. So that's why do organizations use investment appraisal? So they consider those 2 decisions. So once they are happy with that, then they can proceed. So there are items which are irrelevant or irrelevant cash flows in investment appraisal. So in other words, at the end of the day, we like to get the movement of cash flows. But there are items that are relevant, as well as there are items which are irrelevant when we look at the following. For example, the first one is additional cost of fixed assets. As I've mentioned, that if you acquire an asset, So there are costs which are involved. It's not only the purchasing price of an asset, but transportation, installation. So we need to consider those aspects as well. So that is additional cost. The total cost of fixed assets includes any transportation and installation costs, as these are substantial costs incurred by organization when fixed assets are acquired. So in other words, these are items that should be considered. So we should check whether it's relevant or irrelevant when it comes to cash flows in business. Then the next one is your depreciation, which is your imputed expense. In other words, this one is a non-cash item. So it doesn't much involve the movement of cash, but when it comes to operations, so that's why when you prepare your statement of comprehensive income, your depreciation is an expense. So it will affect the profit of the business because it must be considered. Also, the plant that we are willing to buy or the project that we like to invest as a company. So also we need to consider whether they'll use which method when to work out the depreciation at the end of the day. So which method they are going to consider. But the depreciation, it will affect our profit at the end of the day. The next one is incremental cash flows. These are additional cash flows that represent the change in the organization total cash flow that occurs as a direct result of accepting the project. So that is incremental, because if we decide to expand or to move to a new project, and then that means we need to invest more in that project. Or if it's we renew, it's a replacement. So if you do a replacement, their cost. So they'll be incremental in our cash flows. Then the next one, interest expenses. We know that this also, it affects our cash flows because we need to pay interest, especially if you use your external source to fund your project. So there are interests that you need to consider as well. So that is your interest expense, your opportunity cost. This is the value of the organization will lose as a result of taking the next best alternative. So there are opportunity costs that are considered if we decide to take the next best alternative. Some costs, this is a cost that's already been incurred. An organization has signed a contract. If the machinery that you are buying is outside the country or even in other provinces, already there are contracts that you already signed. Those are sunk cost. Then the last one is your working capital, which we have to consider because we'll need stock, we'll need inventory, we'll need to pay our receivables, we need to control our creditors or your payables. So those items should be considered when you prepare, when you have to choose the right project to consider. So those are items that you need to look at. So maybe let me also conclude by moving to 18.6, which is your methods, the methods that we use when we work out the capital budget. So there are methods that you consider. The following appraisal methods are used to decide whether or not projects should be accepted for inclusion in the capital budget or we have to reject. So it will depend on the results that you are getting. So the first method is paid back method, which is your initial investment. You divide by annual net cash inflow. So when you look on your textbook on page number 332, you'll find illustrative 18.1, where Zeus Ltd invested 2 million in a project that is expected to generate net cash flows of 500,000 for the next 5 years. But when you work out the results in page number 332, the results here, it's only 4 years because the estimate, it was 5 years. Let me invest 2 million with the cash flows of 500,000 for next 5 years. But your results, it gives you 4 years. But with this method, you can take the results and say, because my estimate, it was 5 years, but now when I'm working out my results, it showed me it should take me only 4 years. But that one, you can't take as a decision to say, let me consider this project, because there are a number of methods or you need to follow before you consider the right one. All right, there are advantages and disadvantages of payback period. It's a simple to calculate and easy to understand because you use the formula. Same formula will be used to work out the payback method. More emphasis is placed on an earlier cash flows as they are likely to be more accurate than cash flows that come in later years. Disadvantages of the payback period: the time value of money is ignored. The cash flow that come after payback period has been met are ignored. So those are advantages and disadvantages of using. Then the next activity that they're given here on page 332 is an example which is 18.2. So what is required here? Determine if this project will be accepted or rejected using the payback period or payback method. So in that illustrative 18.2, we are giving cash flows up to year 5. The organization has a standard payback period of 3 years. But you work out the solution, it gives you 0.25. So it will give you the results. It will show you in the year number 5th year. So what are cumulative cash flows from year 0 up to year number 5? So, but you'll use this illustrative. Also, it's covered in your TAT. There is a TAT that you do that we have to consider how to work out payback method. And the next one on page 333 in your textbook is accounting rate of return. Is the only appraisal method that uses accounting profits as opposed to cash flows. So in other words, the other methods, they consider more of cash flows, but only accounting rate of return that focuses or that use accounting profits more than cash flows. So ARR, that is accounting rate of return, which is your average annual profit. You divide by average value of investment. Here it's not equal to, it should be times 100, because at the end of the day, you work out the percentage. Times 100, you divide by 1. And then this illustrative example is shown on page number 334, which is 18.3. So the results here, it shows 36%. If you read Senchem Ltd is considering investment in a capital project that requires 150,000, where the required rate of return is 12%. Straight line depreciation will be charged on the capital expenditure over the 5-year lifespan of this project. The equipment will not have any residual value at the end of its useful life. The cash flows expected over the lifespan of the project are as follows. You are given the cash flows year 1 up to year number 5, but your results at the end of the day, it gives you 36%. While the company, it has projected that requires 150, where the required rate of return is 12%. We are above 12%. With the results, it shows 36%. There are also advantages and disadvantages to consider when you work out the accounting rate of return. So the next method that I have to give you as well, net present value. I know it's in chapter number 17 in your textbook. I love tutors, they show you how to work out net present value because there are tables that you need to know, but it will be given to you as well. Your net present value. So it's calculated on page number 335 in your textbook. That is it represents the net benefit or net loss in present value terms and on the project. It is calculated by discounting the future after tax cash flows and then subtracting the initial investment. So that is the illustrative on page number 335. So I know tutors covered this part because in the coming assessment, you'll find that it's a multiple choice questions, MCQ, but also you need to know how to work out the questions, because you'll be giving statements and then you need to work out the answers. So there are also disadvantages and disadvantages of using this method, which is net present value, which are there in your textbook on page number 336. Also on page number 336, you'll find your profitability index. We don't use much of this for now, but you need to know there is profitability index of a project, which is calculated by dividing the present value of the cash flows of the project by its initial investment. So this one is shown on page number 336 and 337. That is how to work out the profitability index. And then there is an illustrative on page number 337, which is 18.5. Then the next one, which is your last one method that we look at, it is an internal rate of return. There are also advantages and disadvantages of using this method. It requires that the actual rate of return of the project be calculated. It is the discount rate at which the net present value of the project will be zero. That is, it is the rate at which the project breaks even. You'll see when we do CVP, breaks even, how to work out the break even. This means that the IRR, not ARR, the total present value of the discounted cash flows is equal to the total present value of the cash outflows of the project. So this is how they show the IRR, where A is lower discount rate, B higher discount rate, C NPV at lower discount rate, D NPV at higher discount rate. So here we use a certain table. Also, it'll be shown to you by tutors how to do those activities, how to answer those questions. So there's an illustrative on page number 338, which is 18.6, using this information. And then we need to work out your IRR. If you see on page number 339, there are results. The first one is System ITSS. It shows 15.72%, while System CO COIL, it shows 14.83%. So here we need to consider which one to consider or which one to reject. So it will depend on the results that we are getting. On page number 340, you find advantages and disadvantages. It considers the time value of money. So in other words, if there is time value of money, there is a table that you follow, or that you know, especially on page number, let me show this one. Is there in your page, in your textbook on page number 320, 321, you'll find those tables on chapter number 17 in your textbook, but also it will be shared to you so that you know this is how you need to work out when you work out the internal rate of returns, because when you are writing an assessment, you need to consider those tables. So there are advantages. The first advantage for using internal rate of return, it considers the time value of money. Simple, makes the concept easy to understand. All cash flows are taken into consideration. That is IRR. But when it comes to the other method, so we focus on the profit made by the company. Let me take only two disadvantages of internal rate of return. IRR can accommodate changing interest rates. That is one. Number two is a relative figure, whereas NPV is an absolute figure. Therefore, IRR can give a different ranking from the ranking proposed by net present value. So those are items that, those are methods that you have to use, because once you work out all these methods, then you need to choose which alternatives, which project has a favorable results, which one to consider, which one to reject. So it will be coming from the following method. So that is your capital budget for today. Any questions or comments? Yes. Raise a hand. Hello, anyone? Questions? Students, where are you? Any questions, comments? Yes, I saw a hand is up. Yes. I think it's greeting me. All right. Any questions? Any comments? That is capital budgeting. So in other words, before you invest to any program or any project, you need to work out your capital budgeting, because as I mentioned, that your capital, it's grouped, your money that you use when you need to start a business, it must be divided into groups. Your capital budget, your working capital, your fixed capital, your working capital. So because this one, it will deal only with the purchase of assets. So there are costs which are involved when you're buying any asset that you need to consider. So those are capital budgeting. Before you attempt to go to a new project or it's a replacement project, so we need to consider certain aspects before you answer. You take the right alternative. You consider certain aspects. So it's so important that you consider certain aspects. All right. Any questions? Your homework, it's go and read once more. The recordings will be uploaded today. You do your activity, your touch. You look at chapter number 16, chapter number 16. Also, tutors, they send you a link for the work that you've done this week. Also tomorrow, you can join also the Westville group. There will be a link also posted to you so that you'll be able to understand capital budgeting. As from next week, please join the same class. 10:30, we'll move to chapter number 16, which is CVP. That will be CVP. All right. Thank you. Thank you for joining this class.